Now, different from Disney, PFIZER management really upset me here because, all right, ladies and gentlemen, in this video, we are going to talk about a lot of different things here, and I'm going to timestamp it down below for everybody. We're going to talk about the winners. We're going to talk about the losers. We're going to talk about stocks that are actually getting very interesting here. Now, I come into today and I dropped a video on Disney last night stating that this is the turnaround. This is the inflection point for Disney. Now, the stock is up over 6% on the day. And if you've been following the channel, we had around a $75 price target, hit $78 a share. You all know that I did start building into this position. My wife is a huge Disney fan, and so she bought a lot more than me, so she is absolutely killing it today. And so this is strictly a management story here. This is all about free cash flow. This is about cutting costs and running an efficient business model. Now, what makes Disney interesting, and I think what a lot of people are missing, is when we look at the media sector overall, most media companies do not have as many levers to pull as Disney does. Now, Disney has a tremendous amount of IP, and that's one of the hardest price targets to put on Disney. If you guys watched the video last night, I did say we would probably break above $90 a share. I do believe there's going to be a content consolidation within the streaming world, and I think Disney's really set up to do well here. Not only did they beat expectations, but they're looking to cut $7.5 billion. The company went from right around a little over $1 billion of free cash flow, now pushing over $5 billion of free cash flow. And we can see that the streaming is actually starting to get pretty interesting here. Yes, they're losing $387 million, but the year prior was $1.4 billion. Just added 7.5 million new subscribers to their platform. So we're seeing efficiency here pick up on a free cash flow basis on the overall business, but also the streaming aspect here is now starting to get interesting. Now, I did my Disney analysis in the beginning of 2022, I believe, and we had them projecting to do $84.5 billion of top line revenue. They closed out the year a little over $88 billion. And so we're going to hold fast here on where revenue's going. I'm still going to stick to my guns that they're going to do right around $95 billion next year, possibly pushing over $100 billion in 2025. You can see here we had a price target around $75, but I said if you have conviction in this play, anytime it hits the 70s, I think it's a good time to dollar cost average into this position because they have so many levers that they can pull. Bob Iger back in here. So the real true bet is actually management executing on this business proposition, and they're doing a very good job in my personal opinion. I think overall, it was about a C+ grade on the earnings, but when we factor in that this stock was trading for over $180 a share, started trading in the 70s, any sort of positive news coming out of earnings is obviously going to move the stock in the right direction, and we're starting to see that here, which is now going to lead us to Realty Income. This one, again, I said around $45 becomes an interesting stock to own. Now, overall, I'm not a huge fan of the REITs. Right now, real estate's in a transition standpoint. We don't understand where commercial real estate's going to go. We don't understand where interest rates are going to go. Therefore, the growth rates on your bigger time REITs is really hard to project out. Now, with that being said, I actually think Realty Income is doing some interesting things here because their hands are tied due to the interest rate market. They are making acquisitions and they are investing outside of their normal behaviors to find creative ways to innovate your business. And with real estate, it is really hard to actually be innovative because the bottom line is you have to find assets that can produce net cash flows. And that's the objective of managing these REITs. And so it becomes harder and harder to find these distressed properties or properties that are good deals that can cash flow strong in a market that's really uncertain. But doing mergers and acquisitions makes a tremendous amount of sense. And I think that the recent acquisition here was a fair deal overall. Once again, like Disney, I'm going to steadfast on this one. And I think anything that reaches that $45 and below becomes extremely interesting on this company, which is now going to lead us to Raytheon Technologies, a company that I recommended right around $72, $73. We look at the significant sell-off that took place here. It was nothing really fundamentally wrong with the company, and I thought valuations actually made sense between that $68 to $72 mark. We can see here the 52-week range was $68.56 to right around $104. Moving over to Verizon. This is definitely not a sexy name whatsoever, but this was all about a free cash flow story. We talked about Verizon and we talked about AT&T. Once they started hitting these depressed prices, we can see the 52-week range on Verizon was $30.14 with a high of $42.58. So what we see here is a free cash flow analysis along with an EBITDA analysis, which we get a $29 DCF analysis, and we get a $37 of a multiple to EBITDA. And I stated that in order to get interested in this company, it has to be trading closer to that $30 range, and that's exactly what happened. Capital expenditures are absolutely going up here. They have a tremendous amount of toxic debt, But the storyline was that management was still guiding for strong free cash flow, which means that they're going to be able to still pay that dividend. They're going to be able to pay down their debt and still invest in future growth. And so both AT&T and Verizon were interesting at those depressed levels, and we're starting to see price discovery with both of these companies, which is now going to lead us to PFIZER. This one was a loser for us. I did the best that I could with the fact that a few earnings calls ago, they were guiding for a significant dip in revenue, which I accounted for. But in the recent earnings call, they completely changed their story, and a few days before they reported earnings on a Friday afternoon, management came out and guided down, and the stock sold off. And I did have right around a $35, $36 price target on this company. With the recent earnings guidance here, we obviously had to guide down. Now, different from Disney, PFIZER management really upset me here because they could have told us exactly what was going on, but they were way too optimistic in their outlook. And that really impacted our analysis on the stock. So therefore, I'm definitely going to own that I was wrong on this company, but I also want to make it clear that management, I think, misled a lot of investors and made it extremely hard to understand what was truly going on with their business, because I do think that they weren't being completely transparent. So now that we got all the bad news out of the way, let's talk about PFIZER fundamentally. Earnings are going to be a problem for the company in the foreseeable quarters here. They're building out their pipeline. They have the acquisition of CGen. The problem with the acquisition of CGen is probably going to be the cost of this deal getting done now with interest rates rising. It's going to be much more expensive to finance this deal. And so that is a concern of mine. I did take that into the analysis that we're going to look at here very soon. I want to make it clear that this 5.5% dividend yield could be in jeopardy here. I would not be surprised if they slash it down to 2.5% to 3% dividend yield to reserve capital on building out their pipeline. But I will find it interesting if PFIZER does touch that $26 to $27 mark. Is that going to happen? Really hard to tell. It is teetering on a $30 stock price right now, so we could see a big washout on PFIZER. When we look at the history of the chart here, we can see its ebbs and flows, very cyclical business, depending on what they have in their pipeline, how impactful it is. And so there is going to be volatility with PFIZER. But I do think it will find a bottom in those mid-20 area. And so I don't think there's a tremendous amount of downside risk because they are building out their pipeline. And I do think over the next 5 to 10 years, this is going to be a very innovative company. But I would say overall management really let me down as an investor, which is now going to lead us to CVS, which overall healthcare has been kind of in this gray area, minus a couple names that have some massive weight loss drugs. CVS is another one that is definitely getting hammered here and is a deep value play here. There's nothing management is doing wrong in my personal opinion. This company pays a dividend, it buys back stock, it has strong earnings, has made some solid acquisitions, and when you look at the company's valuation here, trading at $86 billion, you're basically getting all their recent acquisitions for pretty much free and owning the CVS side. And so this one is still a deep value play. Now, I do have two drastic outcomes for this company because on a free cash flow basis, this company is projected to do between $12 to $13 billion of free cash flow. And so I do have a personal price target between $56 and $60 a share. This company got recently as low as $64 a share. As most of you know, I did build in right around $66 a share. And so this one has been very disappointing for me overall, at least from a price discovery standpoint. The market is just dismissing this one. Maybe there's something I'm missing. I understand what's going on overall with Amazon wanting to get in the space along with Mark Cuban. This is beyond just CVS. They have many other aspects of their business beyond just their pharmacy storefronts. So I would say overall, this has definitely been one that is frustrating to own. But there's nothing I'm really seeing that's making me want to sell this stock. Yes, the price discovery is not coming through on the market. It's being dismissed by the market. People don't like the stock. But when you look at the return of capital here of paying a 3.5% dividend, they're buying back stock. The company's earning $2 a share. It's trading at a forward PE right around 8 times earnings. It is extremely cheap when you compare it to its peers and still has a tremendous amount of levers here to grow. And even if it doesn't grow, you're still earning $13 billion of free cash flow. Fundamentals are still pretty solid in this company. I'm not seeing a reason to really get rid of it, like we were seeing a reason to possibly reprice a company like PFIZER. I don't see the repricing aspect in a company like CVS quite yet. Now, of course, things could absolutely change, and the market could be seeing this before we do, or there could be tremendous value here. It's one or the other. But I mean, if we look at the chart, we're basically trading at 5-year levels, had a massive run up to $106 and is almost halved from those levels. So this one's not really a winner nor a loser. I think the verdict is still out on this one. I think it could get as low as $55, $56 a share, and the verdict would still be out because that's an ideal price for me. I think if it gets any cheaper than that and it starts having fundamental problems, I'm definitely going to have to take this one as a loser as well. Now, I want to talk about some companies that are actually becoming pretty interesting here. First one's going to be Cisco Systems. Now, I did an analysis on this one. Let's pull it up really quick. Now, I have an ideal price target between $40 and $45 a share. Currently, the stock is trading at $52 a share, and I really love the Splunk deal here. I think they massively overpaid in the short term, but I think long term, this is going to be a heck of a complementary side to their business, and it's going to create top line revenue growth that I think the market is actually discounting here. This is definitely one company I really do want to add to my portfolio in the very near future, so I am hoping that it does start reaching these $40, $45 levels. We look at the 52-week range, $43.92 to as high as $58 a share, and so there is opportunity here on a significant pullback to be getting in at my ideal price target. I think this company is one of the more interesting companies out there when we look at value, when we look at growth at a reasonable price, we look at future growth opportunities for the company, and the recent mergers acquisitions has been very, very solid. They didn't need to go to the financial markets for this deal. It was an all-cash deal, which you have to like. Means that the company is fiscally responsible. So I think there's a tremendous amount of opportunity in the next 5 to 6 years for Cisco Systems. And ladies and gentlemen, consumer staples has been selling off like nobody's business. But if we think we're going into a recession, consumer staples should outperform here. Now, I want to highlight Smuckers. Smuckers did a deal with Hostess. I think they absolutely overpaid by a significant amount. I think it was a horrible deal for Smuckers. And I think the market is pricing that in as the stock has fallen down from $163 a share down to $108 a share. It's rare to see consumer staples sell off that hard, especially consumer staples that have decent fundamentals. And Smuckers definitely falls in this line. And so how much is enough? I definitely think we're getting to an interesting point where we have to start looking at Smuckers. Multiple reasons why I really like this company. Again, we look at the 5-year history price on the company. It's basically trading at a 5-year low. Yes, they made a bad acquisition, but I think the market's priced in the majority of the bad acquisition at this point in time. And so right around $105, I start thinking this becomes an interesting buy. So we have two price targets here. We have the free cash flow price of sitting right around $108 a share and the multiple of EBITDA sitting right around $77 a share. I think the stock becomes interesting right around $105 a share to $93 price target. And what makes this interesting is one of their key levels of support is actually $93. And one of their other key levels of support is $105. So I'm going to say between $90 to $105 on Smuckers. Be very cautious on averaging in. I wouldn't try to time this, but I would say buying some at 105, buying some at 95, buying some at 90 could make sense here. I believe they have just under 28% market share of coffee here, and that's going to be Dunkin' Brands, Folgers, and Cafe Bustelo as the big name brands that they have. And the reason why I'm saying coffee is going to be important is if we really think the consumer is going to cut back here and they're going to start doing shopping at home, well, obviously we know about the Smuckers peanut butter and jelly. We know about the Hostess snacks brand. But the coffee to me is one of the interesting tailwinds that I think we're going to see consumers first cut back on. Those $8, $9 lattes might start being made at home for 1/100th of the price. Hopefully everybody enjoyed my dive into the winners, the losers, and the companies that are starting to get interesting. Now, there's definitely more than 2 companies that are starting to get interesting. I'll be dropping a video on those later. As always, appreciate your time. Thank you so much for spending it with me. We will see you in the next one.